This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. I'm your host, Justin Goodbread, and today's title is, what are the best financial reports for business owners to examine? Now, I don't know about you, but I like financial reports. At this point, my brother would say, I hate financial reports. I guess it's all on what you like. To me, financial reports provide a roadmap for you, the business owner. But many times I run across business owners who don't know what to look at, what type of reports to analyze. So today I put together a couple of financial reports that I believe every business owner should know. You should look at these information. Currently, at this time of the year in our company, we're analyzing year-end reports. We're looking at several of these reports for our company, myself, and we're looking at these reports for our clients and trying to ascertain the exact moves that the clients and myself, in this case, need to use or do throughout 2019. So I want to go over some reports that you may be familiar with and tell you some key points that you may want to look at on each report. So the first report is probably the most important financial report for a small business owner, and that is the balance sheet. The balance sheet covers the liabilities and the equity, or some people call it owner's equity, to determine the assets. So there's a formula involved in the balance sheet that you would take the liabilities plus the owner's equity equals the assets. So on the balance sheet, you will have liabilities. And liabilities are broken up oftentimes into what's called short-term liabilities and long-term liabilities. Short-term liabilities are things like the accounts that you owe. They're often called accounts payable. And taxes. Maybe it's payroll taxes. On our liability statement in the short-term liabilities, we have a liability rolling of what the company has to match on the 401k. So when we have payroll, we do safe harbor match, and sometimes that appears depending on the month end and how the payroll cycles through. So you may see that on the short-term liabilities. In the long-term liabilities, you're going to see things like debts or personal loans. And so these are typically the liabilities or the payments or the debts that you owe, which are capitalized by some type of an asset. So maybe you have an equipment loan. That'll go underneath the long-term liabilities. So you'll typically have your liabilities. Then you'll flow into your assets, and your assets are broken down in a number of different ways. You could have your current assets, which may include cash. You could have fixed assets, which may be land, property, or equipment. And so on your balance sheet, it'll show you your liabilities and your assets. The cool thing for me on the balance sheet is if you take a balance sheet and you compare it year after year, you can see revenue trends in the terms of how much revenue is flowing through to the balance sheet. Often you'll see where net income of your company is shifted over, or maybe owner's equity is shifted to the balance sheet. So you can see how your net worth is increasing year after year, at least your book value net worth, what's reflected on the balance sheet. In my world, we actually have to use the balance sheet to create a computation for the regulators. They want to see that we're liquid, a certain value per state. And so we have to use the balance sheet. So the balance sheet's not really forward looking, but it provides you a single snapshot at that moment in time that's typically a month end or a year end. I like the year end, especially at this time of the year in January, February. I like to look at past years and compare the balance sheets and the various categories on those balance sheets over years. And it just tells a story to me. It tells me the health of the company. You can use the balance sheet to calculate the owner's equity percentage, what the return on asset value is for the owner. It's one of the things you can do with a balance sheet. The next report, which is probably more popular than the balance sheet for us business owners, and that's the income statement. Now, the income statement is loosely referred to as the P&L. I often use the terms P&L, standing for profit and loss statement. But to me, for a forward-looking, for where most business owners are projecting, the income statement is just as important as the balance sheet. Now, the profit and loss statement covers a period of time. Usually it's on a month-by-month basis or a quarter-by-quarter or a year-over-year. And it shows you whether or not you've made money or lost money. The cool thing with the profit and loss is you can use it to project a number of different things. So we've talked about the profit and loss before in the episode. So just as a cursory reminder, on a profit and loss statement, you're going to have your revenue portion, how much money the company makes. You're going to have your expense portion. That's broken down into expenses or cost of goods. And then you'll have a net profit, net income at the bottom of the income statement, which is the amount of money the company has earned. So on the income statement, automatically, we can look at, if we ran a year by year comparison, we can see if revenues are up. We can see the trends of revenues. If we have the income statement or the P&L properly divided, we can track where the revenue is coming from. We can also see our increases and run calculations to why our expenses have increased or decreased in proportion to our income or to our revenue. Ultimately, we can track our net profits to see what our return of our asset is. This is also a way you can calculate that there. So the income statement is, to me, with the balance sheet, those two documents, you can almost read anything you need to from any business with those two statements. If you put the two of them together, it becomes a very, very powerful past and future looking set of documents. So to me, those are the two documents that everybody should analyze. Now, before we go any further, how often should you analyze? Well, to me, the balance sheet, I review the balance sheet annually. Whenever I make a purchase or pay off a liability, I want to make sure the balance sheet's reflected properly, but I don't spend a lot of my time personally on the balance sheet. That's the CPAs and the accountants world. Where I spend most of my time is in the income statement, on the profit and loss statement. And I look at those documents pretty regularly. I look at it from a projection standpoint in January. I look at it from a conclusion standpoint in December. I look at it on a quarterly basis to see how our quarter wraps up. I look at it on a monthly basis to see if I have any expenses or make sure certain expenses, which I may be strategic in, are properly categorized. So to me, the income statement is where I spend most of my time in my personal business. Now, the calculation on the income statement is you take the gross profit minus the total operating expenses, and that gives you the net profit. And as I mentioned, you also could have sales minus cost of goods, which would give you the gross profit. So to figure it out what your net revenues are going to be, you're going to take your sales, your total revenue, your sales minus your cost of goods. Then that's going to give you your gross profit. Then you take your gross profit minus your total operating expenses, and that gives you your net profit. So those are your two calculations that you can make pretty easily from the income statement. Another report which I view as valuable for certain businesses is a cash flow statement. It's very similar to the profit and loss statement. The cash flow statement is focused and primarily concerned with profitability. That's where its focus is. So the cash flow statement is going to take a little bit different approach on it. It's going to specifically look at how much money is coming into the company and going out of the company in a specific time period, and how it affects the daily operations and the overall financial position. It's typically prepared at the end of each month because of the way inventory works in inventory-based companies. And typically expenses are paid on a monthly basis. So it's typically a month-end report that you can run. What you're looking for is a calculation similar to this. You're looking for the beginning cash balance. So how much did you have on the books on the first day of the month? Then how much inflows did you have? And how much outflows do you have? And then what's your ending balance? You know, many of us do this automatically just through our basic checking account. Many times we don't think about it, but this is what we do. We'll look at our business checking account and we'll say, okay, we have $50,000 in the checking account and we had deposits of $40,000. We had outflows of $38,000. At the end of the month, we had $52,000. So we made $2,000. That's a quick assessment that we make. It's a little bit different inventory-based businesses, though. You can run a report which will summarize all the different flows happening in the business. So to me, the cash flow statement, especially if you have inventory, is one of those reports that you just want to look at. Another report that we want to look at is what's called the accounts receivable report, or sometimes they call it the accounts receivable aging report. I've even seen it as called the AR. So the accounts receivable aging report. And what that report is reflecting to you is how much is outstanding or how much revenue is outstanding that you've currently invoiced that hasn't been paid. And so when you look at the AR report or the AR report, you're going to notice that there's about 4 different categories for most of the time. It'll show you what some people will call it a current, or some people will call the first category a 1 to 30, and that stands for the days. So if you invoice somebody and the invoice is outstanding for the first 30 days, sometimes it's referred to as current, or 1 through 30. The next category is the 31 to 60 day, and that's the 30 days late. So if you invoice somebody that's payable upon receipt and you look and you now have a fair amount of money in the second category between 30 and 60, it means that you have some revenue that you need to tidy up real fast and collect. The third category is one that goes from day 61 to day 90. So that's the next 30 days. That means they're now 60 days past due. And then your last category is greater than 90 days. Now, whenever you look at an AR report, one of the things I look at in particular for businesses is how much money is sitting in each one of those 4 divisions or 4 categories. What I'd like to see is over 90% of the money sitting in the current or the 1 through 30 day time period. If we see greater than 90% of the revenue that's been billed in that 1 to 30, that means that the company has a very good collection system in place. Whenever I start seeing a lot of money in that 90 days overdue, it means we have some major problems on the collection side of the company. Basically, you've done work that you haven't got paid for, or you've invoiced incorrectly. One of the 2 things have happened. Now, what needs to be noted on the accounts receivable agent report is whenever the dollars shift from one category to the next, when they shift from the day 1 through 30 of the current to day 30 through 60, and then from 30 to 60 to 60 to the 90, and then ultimately to the 90 days past due, each time they move into that next category, it does 2 things. Number one, it's going to cause collections to be harder. The farther out that the majority of people go from owing a bill, the harder it is to collect it. And now you got to deal with collection issues. One of the things that I often look at, though, is whenever it comes to selling a business or whenever I'm helping a client buy a business, if I see a fair amount of money that's outstanding past the current or from the 130, then that's going to affect the purchase price of those accounts receivable, or it could potentially affect the sales price of the business. So the accounts receivable report is something you want to stay on top of. You do not want to let it go past. You just don't.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
Another report you may want to look at is what's called the AR Day versus AP Day report. AR versus AP. AR stands for accounts receivable. AP stands for accounts payable. I'll typically run this report in a service industry that has high billables. And I can track down to see if the service that's being provided is actually profitable. So here's how that works. An AR day versus AP day. Let's say that you are a dentist and that you had a $20,000 collection day. It was a good day. You did a lot of crowns. You did a couple of full mouth reconstructions, and you had $20,000 in one day, which would be an unbelievable day for many dentists. But let's say that's the case. And all of a sudden, your accounts payable for that day is $21,000. It could mean that you worked and had a lot of revenue, but your payables for that day far exceeded the profit margin that we're shooting for. So you want to look at the ratio between the accounts receivable and the accounts payable. Now look, on this particular, there's not a hard and fast ratio, and it's going to shift industry to industry. The one I like to look at is I like to look at the margin of the company. So let's say a company is operating on a profit margin of 30%. How would we know that? We go back up to the profit and loss statement. We see the total revenue of $1 million, and we see there's $300,000 in net profits. That's a 30% ratio. All of a sudden, if I look at an AR day versus AP day report, and I see the ratio for that one day had a profit margin or had a ratio of 10%, then we need to figure out why our ratio was not at least at the standard of 30% of the margin for the annual year. Because if we do a lot of 10% days on our profit margin ratio, then we could end up affecting our net profit margin for the whole year. So the AR day versus AP day report is a great report to take a look at. Another report that I like to look at with almost every business is a budget versus actual. Today's technology often allows us to set up budgets. In fact, I'm working on the budgets for my companies right now. I'm looking at both a zero-based budget and a year-over-year budget. and I'm trying to figure out what the budget's going to be for this year. And what I can do is once I have the budget built, then I can run the actual in comparison. So if I'm anticipating that the revenue is going to be, let's just make a number, $5 for the month, and all of a sudden I had $6 for the month, then does that give me latitude to increase my expenses or not for a growth initiative or for profit's sake? So when you run a budget versus actual, you can compare where you're at versus where you hope to be. And it'll allow you to identify if overspending, underspending. It allows you to identify if you're on track with your revenue, if you're above track, if you're under track. It allows you to look at the entire structure in comparison to what you hoped. So I like to look at the budget versus actual report. Now, another report is called the Daily Average Sales Report. You may recognize that as an inventory management report, and it is. It's going to show the average sales, typically in units, over different periods. For example, you may be tracking a particular TV. If you're like a Best Buy, they may be tracking specific inventories, and they may look at TV sales month over month, a quarter over quarter, over year, and they're typically going to run them on a side by side. The common flaw, though, whenever you're dealing with inventory management is that the reports typically only show items that have sales in the period question. One of the things we're looking for is we want to look at items which should have sold or which remain on hand. And so whenever you're doing inventory management, the average daily sale report, we want to look at and make sure we're looking at the whole inventory side by side, not just the things which we are tracking as hot items. And if we do that, we can identify products which we should reorder more of or should not reorder more of. We can change a purchasing policy on certain products. So the daily average sales report, it's an inventory management system, but if you're dealing with inventory, it helps you to track and make sure that you're ordering or changing the purchasing process for maximum value to your organization. Another report that I like is the operating cash flow report. Basically, I've heard it called lots of names. I call it the operating cash flow report. Doesn't matter what you call it. It's a report that you want to look at. It shows you the state of the financial viability. It's able to look into the future and in the past. It's pretty cool. To me, what it's going to look at is how much money do you have on hand to operate the company? One of the questions I often get is, Justin, how much money does my company need to keep in cash? And so when I ask clients, well, what's your operating cash flow forecast say? Well, I don't know. So we end up building an operating cash flow forecast to show here's how much money we need on a month-by-month basis, according to the budget, according to all the various scenarios, to analyze that question and determine how much cash we need to have on hand for that particular business to weather either a financial storm, an economic storm, a political storm, or a growth season. You know, growth season can be just as detrimental to the company if you're not positioned properly. So I like the operating cash flow forecast. I like to look at that and help people build that report. Last report I'm going to give you is what's called net profit margin over time. Now, net profit margin is the number of cents in profits that's generated from every sale. Similar to the accounts receivable versus accounts payable daily ratio report, it's basically a slight variation depending on the industries. Okay. So in a particular seasonal industry, like our landscapers, pool builders, contractors have a hard time in December, January, and February making a lot of profit. We can track and make sure that the net profit margin, instead of on a month by month basis, we can track it over a time period. Maybe it's on a quarterly basis, or maybe it's on a cyclical trend. So like our nursery that I used to own, we would track it during the growing season and look at our net profit margin over time. You know, if we looked at net profit margin over an annual basis from January to December on a nursery that only has 6 months of the year growing season, then it really doesn't help me make determinations on how to grow the business or how to pinch pennies or et cetera, et cetera. But if we look at the net profit margin during the growing season, let's say it goes from April to August, from A to A, and we see that during this time period, our profit margin is 70%. Well, now we have the ability to make determinations as to how to cut back, how to grow, how to increase capacity without hurting the overall annual numbers for the company. I know you're probably bored to death right now. Those are a couple of different reports that you can look at. Not every one of those reports are going to be applicable to every company. This is why you need somebody on your team who can help you make determinations as to how to grow the company, but more importantly, how to grow the value of the company. And each of these reports will show a professional or someone who's focused in on value exactly what your company needs to do in the finance department to help push the value of your company to the maximum it can be. And with that, guys, I'm going to wrap it up. Hey, check out the Financially Simple blog. We did some changing and some tweaking on it. We're doing a little bit differently now going forward. And I think you're going to like the format a little bit different on the blog. We're not getting as wordy in the podcast as we have in the past. Instead, we're going to save those for the books. I have our first book coming out here before too long. I can't wait for it. But if you want to read my absolute best writing, check out the newsletter. That is where I write the best. We make sure we cover the material in detail. Sign up for the newsletter. You can sign up right there on financiallysimple.com. You know, like I say every week, life is hard, life is good, and life can be frustrating. Money, financial reports, they don't have to be, guys. This is basic common sense once you understand it. Let's just continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.